Sector allocation is a pretty diversified. We have communication at 8%, consumer discretionary at 12%, we have consumer staples at 8%, we have energy at 4%, we have financial at 8%, we have healthcare at 12%, we have industry at 8%, we have real estate at 4%, we have technology at 32%, we have utility at 4%. So we can see the biggest chunk here goes to technology, and we have healthcare is 12%, which is a pretty good too, and consumer discretionary. So this overall is a very diversified ETF or portfolio. Hello fellow investor, welcome to my channel. This is another update on a brand new ETF that is coming to the market this coming week. If it's your first time, this is Mr. Man on my channel. On this channel I talk about investing and all the updates when it comes to your passive income investing and any other type of investing. So we're going to look at what it is in this ETF that is more attractive for you to invest your money. So this is Hamilton US Equity Yield Maximizer ETF, and it says coming soon, high income from US equity. So we're going to look what it has and when it's coming to the market and what's the price. And we know the initial target is 12%, and the ticker symbol is SMAX. So we first are going to look at highlight, which is coming soon. SMAX is anticipated to begin trading on October 26, 2023, which is going to be next Thursday. Today is Sunday. I'm recording this video. We'll look at the initial target is 12%. It's a blue chip US equity exposure with a sector mix similar to the S&P 500. And we're going to look at how many stocks they have versus other ETFs that they have. For example, UMAX, HMAX, and HYLD. Active cover call strategy. What kind of investor this particular ETF is going to be good for is going to be a good for person who, if you're looking for high income, if you're looking for tax efficiency, if you want a modest growth plus income, and if you want your portfolio to have less volatility, these will be a perfect ETF for you to invest your money. When you look at investment objective of SMAX is designed to, of course, pay monthly income while providing exposure to portfolio primarily of large US cap equity security and to reduce volatility, right? This ETF will write cover call and, of course, is not going to use leverage. So this is pretty good because, as you know, when you use leverage, that means you have to pay more. Your portfolio becomes a little bit more risky because you're using that extra leverage, but this one doesn't have, so it reduces the risk when it comes to portfolio overall. So we look at what makes SMAX different. So many cover call ETF write option on out of the money. This SMAX is going to write option at the money, which offers significant higher cash premium, and that's what they're going to pay, that 12%, as compared to S&P 500, which you're only going to get about 2%. SMAX write option on 30% of its holding, which allows the portfolio to maintain 70% growth. So it's a pretty good. We've seen other ETFs that they only pay, they do write cover call on 50% of portfolio, but this is going to use only a little portion, which is only 30%, and you have that 70% for growth. When you look at the target, initial target is 12% and plus, so it's not just going to be 12%, it will be a little bit more. Depends on what's how the ETF will trade in the market, right? We look at the I've covered the portfolio construction, which I've mentioned bigger portion will be on a technology, so that's a good, because it will give you that growth. When we look at holdings now, we look at how many stock they have. We have Apple, we have Adobe, we have Amazon, we have Broadcom, we have Berkshire Hathaway, Salesforce, Cisco, Alphabet, Home Depot, Honeywell International, Johnson & Johnson, JP Morgan Chase, Eli Lilly. We have Meta Platforms, which is Facebook. We have Microsoft Corp. We have Next Extra Energy, Nvidia, PepsiCo, Procter & Gamble, Prologist, RX Corp, Tesla, United Health Group, Visa, ExxonMobil. All in all, there are 25 stocks. So 25 divided by 4, and they're all going to be equal weighted at 4%. So if you look at the calculation, we do 100 divided by 24 by 25 we're going to get a 4%. So each stock will only have 4%, which is a pretty good diversification. I like 4%. We look at the fund details, right? We look at the detail. Hamilton ETF are available for purchase on Toronto Stock Exchange as usual, because this is Canadian ETF. And it can be purchased using RSP, TFSA, or of course a taxable account as well. And if you want a DRIP, which is a dividend reinvestment plan, you can contact your brokerage and they will set up for you. You're going to fill up the form and you're going to have those dividend reinvested if you want that way. But I personally I don't like the DRIP option. I just like to get the dividends and invest my money my own way. When you look at the ticker symbol, is going to be SMAX. So when you go into your portfolio, you look your brokerage, you put SMAX, and then now you can purchase. As I've said, is on a Toronto Stock Exchange. We look at the inception date is coming soon, which is going to be next Thursday on the 26th of October. Investment style is US equity, and it's going to be using cover call to generate those income. 12%. Distribution is going to be monthly. Management fee will be only 0.65, same as any other of their ETFs. They're all about 0.65, so it's a pretty low when it comes to what you're getting. You get 20%, but you only pay 0.65. So that's pretty good. When it comes to a risk rating, is a low to medium, because it's pretty much like S&P 500. So that's all I want to give you update on what's coming this month of October from Hamilton, which is SMAX. And again, it's going to pay 12%. It's going to pay monthly. And we're going to look what's the price, how it's going to be. I figure out the price. I can tell you the price, how much it's going to be. So here we know the first dividend they're going to pay is going to be on 7th December 2023, and he's going to pay approximately, or estimate, about 160. So we know the yield is going to be 12%, and he's going to pay 160. So we can anticipate, or we can calculate precisely the price, how it's going to be. So we take 160, so we can pay 0.160 times 12. You're going to get 192 per share annually. So we take 192 divided by the price I'm thinking is going to be $16, and that will equate to 12. If we look at times 100, that'll be 12. That's your 12% right there. So the price will be $16, and is going to be paying monthly. That's all I have today. It's update, and if it's your first time, just make sure you subscribe, because on this channel I'm always going to give you these updates, and it's very important for you as a passive income investor or any other type of investor to be in the loop for your investment. You have to know what's going on. So that's all for today. If it's your first time, make sure you subscribe, and if this video helped you in any way, just make sure you subscribe. Till we meet again on next video, which is coming soon. Thank you for watching. Bye bye.